Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And in today's program, I'm going to be having a look at, as per the title of the video, regarding the danger that's lurking in the Bitcoin price. We're about to have a counter trend rally. And the question is this going to be the rally that takes us to the blow off top? Or is this a bull trap that's going to create an incredibly bearish pattern? And it's something that we've obviously got to be aware of. I'm also going to be having a look at the bear market levels that we can get to at the end of a bear market in the next 12 months. And as per usual, we'll have a rundown on the various time frames, what's happening in the short term, medium term and the long term. So if that sounds interesting, you know what to do. Get yourself a cup of tea, sit yourself down, eyes on the screen, and let's get cracking. But before I begin, the usual polite reminder, please remember everything in my videos is just for educational purposes, so please always do your wider research before you make any investment decisions or any swing trade decisions. Okay, before I go into the main analysis of looking at the danger that's lurking in the Bitcoin chart, just want to give you an overview of exactly where we are within the 4-year cycles. And that is, whether you believe in the 4-year cycle or not, putting that aside, we have to just look at what's actually happened. And everybody has to make up their own mind. We can only look at the facts in the charts, and then everybody can process whatever the information they see. So the information I want to present to you is that what we've got is that from the bottom of the market, like down here, to the end of the bull market. In the first cycle we had 37 months, in the second cycle we had 35 months, and in the last cycle, which ended in 2021, we had another 35 months. So far in the last two cycles we had 35 and 35, and the one before that 37. And the reason why this is important is because whenever we get into this type of time band, so we would regard the time band for the end of a bull market based on just this historical evidence that we've got, it seems to be following a 4-year cycle, and many people don't really want to believe in the 4-year cycles, and that's absolutely fine, but the charts may be telling us a different story, so we do have to give it some credibility, some weight, because this is how it's actually panned out. Whether people want to extend in their biases to the 2026, and it's entirely possible of course, but we have no evidence so far. All the evidence seems to be pointing to the fact that we are in the time band around about month 35 or month 37 for the market to top out. And the question is, where are we now in the current cycle so that we can take this into consideration? So this is the current cycle that we're in. It bottomed out here in November 2022, and from there the current month here is November 2025, and we're on month 36, and so far we actually topped out the last month in October, and that was month 35. From this month onwards, we have to be alert to the fact that based on the historical evidence, and there's no other evidence apart from that, that we have to take this candle here for the time being anyway. Of course, we keep an open, fluid and flexible approach to everything, but as it stands today, this is the month where it topped out so far at 126,000. And I think it's disingenuous of many people out there, analysts, trying to compare this particular fall with this fall that we had here. And the reason why it's disingenuous is because when we had the fall from this top came in April 2021. And as you've just seen from the historical perspective, this top here was quite clearly not in the time band that you would expect for the bull market to end. So if you did the measure from the previous cycle to this particular month, if we just zoom out here, you see that from the bottom of the bear market to that particular candle in April 2021, we were on month 28. So this particular fall gave us quite a lot of confidence still that we still had one more leg up. Indeed, many people like myself thought that this was going to go to much higher levels, but obviously we ended up in the double top that we did here. So coming back to this particular fall that we've had, so just coming back to this particular fall that we've just had down to the 80,000, this is not the same as this fall here. The time bands are completely different. This is where you would expect the end of the bull market. And it looks to me as that many analysts out there are trying to sell hopium, thinking that we're going to come back and do this. And of course, that is still on the table. But as you know from my channel, we talk about probabilities. The probability that I can see here is that 70% we've topped out here, and there is a 30% chance to get back above the 126 for a blow off top to much higher levels. And we can have a look at the rundown on the various time frames to give us a little bit more information as to where the likely probability is going to be. So this is something that I wanted to alert my subscribers, just to give them a balanced view that while most of the analysts still think that this is going to be the case, and of course it can be, and the main thing is, as investors, we should always be positioned to actually take advantage of this should it happen, or take advantage of the more likely probability, and that is that we're probably going to fall into a bear market and go below this level here at 80,000 very shortly in the coming weeks and months. So what I want to do now is that on the weekly time frame, show you something that's developing and why this particular blow off top seems a less likely proposition than many people would like you to believe. So this is now the weekly time frame, and what I'm really looking at here is the head and shoulders pattern. In classical charting, the number one pattern that really plays out, or the highest probability, is the head and shoulders pattern, and that is that you've already got the development of the left shoulder here, and obviously we've made a high at this point, so this is representing the head. And what the danger is this particular move back up. It looks quite obvious that we're about to have some sort of a counter trend rally to move back up here. And the question is, if we're not going to get a blow off top to much higher levels, then it really opens up the question of where we're most likely to top out over here. And this is where the danger is, because this would then create the potential of a right shoulder. And what we've got here is a neckline. The neckline is going to be here from this point to that point. If I extend that and then extend it to this side, so you'll see that if the market decides to turn back at either of these levels, the top of the shoulder here is at around about just over 107, and this is a major level over here. But of course, we could have a stunted right shoulder, which means it might be a bit lower, at around about the 100,000. So whether it's going to be at around about the 107,000 and it comes back, or the 100,000 and it comes back, either way, you're going to have to look at these levels, because once this breaks down, this head and shoulders will be very, very powerful. If you look left to the chart here, this is exactly what happened in the last cycle. We had a smaller version of this pattern here developing in 2021. So you got the left shoulder, the head, and the right shoulder. This was the neckline, and you can see once it broke there, this was the big move. Came back to retest that level one more time, but that was the bear market that ended up going from 69,000 all the way down to 15,400. And what we've got currently developing is a larger version of this, which is obviously going to be that bit more powerful because it's on a bigger, longer time period here. And just like the narrative that was developing over here, where people refused to believe that we had topped out, there was a lot of positive macro factors going on here, which everybody was referring to at that point, because the bias was that as we were coming back up here from this low, that this was going to go into a higher blow off top figure. And the similar thing is now happening. We've got the potential of the rate cuts coming up in December. We've got quantitative easing also coming up in December. We've got the Japanese market trying to pump trillions of dollars into the market. Inflation seems to be under control. So there's a lot of macro factors which everybody keeps referring to, but the charts are telling us a different story, and everybody can make up their mind what's going to happen here. So that was the danger that's lurking in this chart, which we should be aware of, because once this happens, this is going to have a very big fall. And the question is, how far can it fall should it do this from this level here? And for this, we always have to go back to the 200 simple moving average on the weekly time frame. And as I've shown you many times before, and I really don't want to be repeating the same information, is that the 200 is where the previous cycles have found a lot of support, apart from the last cycle when it actually came back down by around about 30% from the break of that 200 simple moving average, and it bottomed out around 30% lower than the 200 simple moving average. And the chances are, because we've got a law of diminishing returns, the higher probability play is that we're going to fall below the 200 simple moving average. But should it just come back down to the 200 simple moving average, at the moment this is at 55,000. And of course, as time goes on, if we do fall below this level here, this is going to be at a rising portion, at around about the 70,000. If you take the 30% from the 70,000, this brings you down to about 47,000. But if there's a law of diminishing returns, and if this is some evidence of diminishing returns, then the chances are we're going to fall more than the 30%. And where it would make sense would be the 40,000. So tentatively, this is the level that I'm looking at, because if you look at the resistance here, support, and then a lot of resistance and support here, then you take it to this level, again, a lot of support at this level. So this level, around about 40, seems a natural place for the end of the bear market. So those people who've been waiting to buy Bitcoin may do very well to be patient for the Bitcoin price to come back down to around these levels, 40,000. And of course, as it's falling, it's going to be leaving signals so that before you even get to 40, if it's going to top out around 49.50, let's say, then you'll get a signal. The candlestick patterns, etc., will tell you whether it's bottoming out at these levels. So that's something that I'm going to be looking out for over the coming months. Then that is where we should be bottoming out. And of course, here at Wisdom Bites, we're into the Bitcoin miners rather than the Bitcoin itself. And this is where I would be looking to get back into the Bitcoin miners. Okay, so we're going to have a rundown on the various time frames to give us some sort of a clue, some insight into exactly what's happening. If you can take out the noise out there, whether it's bearish or bullish, just put that noise to the side. Forget about the macro factors, forget about the rate cuts, etc., etc. If you just put that to the side and just look at these charts from a totally clinical point of view, this is what I'm going to give you here, just the insight into what the charts are telling us. And on the monthly time frame, what we're really seeing is a high time frame damage going on here. This chart has now got quite severely damaged. On the monthly time frame, the damage I'm talking about is the same type of damage we got in the previous cycle, and as I've shown you in the first and the second cycles as well. Once we fall below the 8 EMA, the blue line that's protruding through the price here, once you fall and close in the time band of the end of the bull market, once you fall below the 8 EMA, that damage there is what's going to drive the price to much lower levels. So this is the danger we've got here. On a high time frame, we've now got a damage on our hands. And the question is, how will this play? And in all of the previous 3 cycles, in the time band of the end of the bull market, once we fall below the 8 EMA, and currently that's at around about 101,000, and obviously if the price comes back up here, it'll push the 8 EMA to a little bit higher levels, and that, as we saw in the last month, was around about 103 and 104,000. If we can get back up by the end of this month, and we're today on Monday the 24th of November, we've got 6 more days to recover this ground, and we are at the moment at the start of what we would term as a counter trend rally. If that rally can take us up above the 103, 104, then everything's okay and the damage will have been repaired over here. But if we can't do that, then this damage is going to make that turnaround, as I've just shown you, and create that right shoulder, and then we're going to come back and break through to the downside. So we can see quite clearly we've got a higher time frame damage on our hands. And when this kind of thing happens, my own strategy in the market is always going to be defensive. And this is why with the Bitcoin miners, in the portfolio that I show you, which I'll show you again a little bit later, we exited our positions at a very good healthy level on the Bitcoin miners. So that gives us a very good positioning, so that if the market wants to turn around and go to the downside, then that defensive posture has saved us and protected us from that downside. However, if the market turns back up and the market gets above a certain level, which I'll share with you a little bit later on, once it gets above that, then we can jump back on and then take advantage to the upside. And this is what normally is the best positioning to have, to be able to get out at the high price, so you can position yourself to take advantage, either to protect yourself from the downside or to take advantage of any upside that might develop. And we'll have a look on the weekly time frame to give us a little bit more insight on a lesser time frame to see exactly what's happening. And once again, we would term the weekly and the monthly as higher time frames to look at the charts. And once again, what we've got here, just like the 8 EMA on the monthly, we've now got 2 candle closes below the 50 simple moving average, the white line that's protruding through the price here. And this is very significant. So when you look at the history, whenever we've gone 2 months below the 50 simple moving average on the weekly in the time band, once again this word, in the time band of the end of the bull market, once you get 2 weekly candle closes below this level, this is giving you a very strong signal that there is a lot of damage in this chart, whether we like it or not, whether our bias is to the upside, whether there's a lot of macro factors that are looking positive for this to do this. And please remember, the last 2 or 3 rate cuts that we've had over these last few months, it hasn't had any effect to the upside for Bitcoin. So you can hope against hope, but the charts are giving us a different contrarian view of the effects of those rate cuts that we've had in the past. And this is what happened in September. The rate cut in September, you can see, was lower than the previous highs that we were getting. So the rate cuts had a negative effect on the Bitcoin price. It's not what you would have expected, of course. With rate cuts, you're expecting the price to go up. But the fact that it didn't do that, that's telling you a story that there's a lot of damage in this chart. And that's backed up by the monthly time frame. And as I'm showing you here, on the weekly time frame, the charts are telling us a different story to what most people's biases are out there. And the first sign of that was that the 8 EMA, the blue line, on the weekly time frame, crossed below the yellow line, the 21 simple moving average. So people talk about death crosses, etc., with the 50 and the 100 on the daily time frame. But on the higher time frame, this takes on a significance in the time band of the end of the bull market. Whenever it's done that, within that time band of the 4-year cycle, then this is what you normally expect going forward. So if you're wondering why I'm 70% that we're in a bear market and that the 126 is the top, and please remember, with probabilities, if it's 70% to the downside, there's also that 30% that you've got to the upside. It's not a question of being right or wrong, it's a question of positioning yourself to take advantage of either the downside or the upside. We are investors here. We're not in a competition to be right or wrong or to make the right calls, because at the end of the day, nobody's got a crystal ball. Nobody can tell you for sure what's going to happen in the next 10 minutes, never mind what's going to happen in the coming weeks or months. So what we can do is to analyze the charts based on what's been happening here. And this is the insight I'm giving you, that the majority play here is not to the upside. The majority play here is for a right shoulder. In the time band that we're at, this is the top for the time being. But should it do this, we are in a good position to be taking advantage of this as well. And that's the best position to be in this type of market. And what I'm seeing at the moment, with a breakdown of the 50 simple moving average, and as I've just shown you with the monthly time frame, the 8 EMA, the price being much below it, it isn't giving any confidence to anybody that with a higher time frames breakdown of the chart, it's going to take a lot of effort, a lot of power from Bitcoin to get through a lot of the resistance that's lying ahead, which we'll have a look at on the daily time frame. There's a lot of resistance it's going to face as we go towards higher levels. Okay, moving on to the daily time frame. And before we have a look at the 60-day cycle to make head or tail exactly where we are in the cycles, I just want to show you how much resistance there is back to the upside here, and why Bitcoin really does need to work very, very hard to anything like testing the 126,000. So these averages give us a little bit of a clue, but also the support and resistance along the way. It will give you some sort of an idea exactly how much resistance there is overhead. The first thing to always look at is the blue line, the 8 EMA on the daily time frame. If I take out all the other averages, you'll see how strong this is. Once you fall below the 8 EMA, you see very clearly how much resistance there is. And while it made a very strong attempt to get back up here, and this was another clue that this is going to be a very difficult level to break back above. That is that from down here, we made a lower high, and since then, we've been making a series of lower highs along the way, and so far we've had 3 lower highs here. So that's something very, very important, because this is what you would normally get in a bear market scenario. But you can see quite clearly with the 8 EMA how it's playing out, and currently we're expecting this big bounce to the upside, and so far we're being rejected right on that 10 EMA. So we really need to get above that level, and that's at 88,500, and so far we've managed to get just above the 88,000. So this is the first hurdle we've got to get above. And then you've got this level here, the yellow line, the 21 simple moving average, and it happens to coincide with the tops of these candles here. So this is going to be a very big effort to come back up and get above this 21 simple moving average, and that's at 95.96. And some would say that even down here at the tops of these candles, there would be quite a bit of stiff resistance at the 93.94 level. And this is the big one here. Below all of these, you can see quite clearly it had a lot of support at this point, all the way, so many candles, even up here. And so this would be what really, I think, from just looking at the charts, this is the higher probability play for me, that the highest this is going to get to is going to be around 99 to 102,000, this region here. And if Bitcoin can manage to get above that level at around the 100,000, you've also got the white line, the 50 simple moving average on the daily, as well as the big one here, the 200 simple moving average at 110,000. So anywhere in between this region here, and you would think that the top of this candle, which is at 107,000, and this is a level I've been mentioning for quite a while, because if you look left, there's a lot of support here, a lot of support here, a lot of support here, and if you go even further back, this level here holds a lot of trading. So the 107 is really more of a line in the sand, and so it's got this big resistance here at 107. This is where I would start to get a little bit more confident that Bitcoin is trying to do something different to what I would expect on a basis of probability. But it would really be at the 116 level where I would be then jumping back on board the Bitcoin miners. At the moment, in the private membership, we've all avoided all this big fall to the downside as we took a defensive measure around these levels with the Bitcoin miners. So we avoided around about the 60% fall that we've had with the Bitcoin miners. And I would be very happy if this actually came back and did this and took out the 116. If it takes out the 116, then the 126 will not be a problem, because if it wanted to double top, it would have already done that at the 126 from this level here at 124. So this would be your double top, and of course you can have a triple top as well. But the way this chart is playing out, if we can get above the 116, then the amount of power that is needed to get to these levels would mean that there'll be so many people bullish at this point that there's going to be enough fuel for this to go to much higher levels. So if I see 116, I'd be turning from being bearish at the moment, 70-30, that's the probability. It's never ever going to be 100%. Nobody can be ever 100% sure. We're always talking about probabilities, never certainties and guarantees. The market doesn't give you that. And if that's what you want, you're in the wrong place. So with an unlikely price above the 116, I would be jumping back on board with the Bitcoin miners to take advantage of a big move then to the upside here in a blow-off top. Until then, what it looks like, so on a balance of probabilities, this is the first test that we're going to get. If we can get above the 8 EMA on the daily at the 88,000, which looks quite likely, I would say, because we have tested this several times, and the more times you test it, then you've got a higher probability of breaking through. So I would expect with a higher probability to break through the 8 EMA, but this is the first test here at 93, 94, 92. This is it. And then if we can get above there, then it's this one here at around about 95, 96. And as you'll see with the cycles, because we're at the beginning of the 60-day cycle now, we should see enough fuel to get all the way up to around about 100. So this is where the higher probability play is for me. And this would form a bit of a stunted right shoulder, as I showed you earlier in the program. So look for reversal candles around that 100,000. But should we manage to get above that, then you're talking about the tops of these candles at around about 110, 111. So the higher we go from the 100,000, the less likely it is to get to the next level, which is going to be 100 here, then and 116 here. But if it does manage to get to 116, then I will flip bullish one more time at this point. Okay, I'm going to move on to the 60-day cycles, which are giving us a very good story about what the higher probability play is here. And that is, and we have to put this into context, because when we're coming up here, going back to the April lows, when you see this kind of thing happening, then you know that we're about to have a blow-off top in terms of, at this point here, around about July, the narrative that was developing over here was that with the time band of the bull market coming to an end around about between October, November, December in 2025, then this was really setting itself up for a very big blow-off top. However, the chart started to behave in a different way, And as I've said many times, you've got to always remain open, fluid and flexible. And when the chart changes from where you thought it was going to go to where it starts to actually go, then you have to change the narrative. And you have to let the chart dictate your decisions and your narrative, and always put your biases and emotions to the side and let the chart tell you what it wants to do. And this is the change that took place over here. So while we expected a blow off top at this point, when we started to see this particular chart playing out in the way it did within the cycles, so we would have expected some bigger moves to the upside from the start of these cycles here. So the first change that I noticed that started to take place was from this end of the cycle, and that was in August 2025. And I mentioned it at the time that what we've got here from the start of the cycle, where you would have expected in the time band that we were in, expecting a big blow off top, that we would have got much more of a bigger move here above the previous high. However, instead of that, we created more of a double top at this point and reversed very violently back. So what you saw with this green candle, we got an outside bar bearish engulfing candle instead. So what we were expecting and what we got were two different things. So without knowing all this that's happened since then, this was giving us a clue of what was to follow. So what we really wanted to know here was if we're going to come back and retest the start of this cycle. So that would have been our second clue that there's something not quite right here. And what we did do was, instead of having some sort of a pullback and then going into the midpoint of that cycle and creating a higher high to give us a right translated cycle, what we got was, before we got to the midpoint, we got a failed cycle where it broke below the start of the cycle. And this was the first alert sign that there's something quite different going on. So any analyst looking at this chart would have picked this up very, very quickly, saying that this is not what you would have expected in a blow off top. This is playing out completely different, a contrarian way that the Bitcoin price is playing out, while at the same time we were seeing SPX and gold and other markets making much higher highs. So there was something inherently problematic with Bitcoin going on at that time. And how we confirmed that was looking at the next cycle, which started here back on the 25th of September. So we had this rundown, as you normally would expect. We had a rundown into the midpoint of the cycle. It was much deeper than we would have expected, and hence the failed cycle. And then we had the opportunity to make amends by going much higher than this level here. And this is what we got. We started the cycle, expected the big move to the upside, which is absolutely fine. This was doing particularly well. It was a nice big move that you would have expected at this point. And what we would have expected is for this to have gone much higher and then coming back into the midpoint, maybe to come back to this level before you make a right translated cycle past the midpoint and then a run down into the end of the cycle. So this would have taken us to around about 130, 140. And then we would have had that blow off top. However, once again, Bitcoin didn't take the chance to repair this failed cycle. And instead, what we got was, and this is what alerted us in the private member section, that this is now playing out to much different levels. And this is why the cycles allow you to make decisions and not wait on any particular predetermined strategy that you might have. It's all very well waiting for strategies to play out, but by the time your strategy plays out, there's too much damage that's been done. And what I'm saying with the cycles is that they give you some sort of a pre-warning that maybe the strategy that you're following may require you to take earlier decisions than you otherwise would have done. So what we've got here is that instead of going to those higher levels, we turned around at another double top or a triple top, if you want to call that. And then instead of actually turning around here to give us some confidence that it's going to go to much higher levels, what we really got was another damage going on in the chart here, whereby at the start of the cycle, we went below that level one more time. And instead of one failed cycle, what you got was two failed cycles in the time band you would have expected for a blow off top. So if you're expecting something and the chart is giving you a different story, then you better heed to that. Then history tells me you better listen to the charts and not listen to the noise out there with the rate cuts and the quantitative easing and all the positive, all singing, all dancing types of narratives that are out there. We have to learn to take out the noise from the markets and listen to the charts instead. So what we've now got is another failed cycle here, because when we started at this point, we broke down here, and this was telling us that once we'd got another left translated cycle, the danger was it's going to fall down here. And this is why at this point, in the Bitcoin miners, we decided to get out in order to avoid this big fall. That seemed like the more higher probability. Did we know it's going to happen 100%? Of course not. But it looked like the higher probability play, with all this playing out here, this was what it was leading down to. And we've managed to avoid that so far. And what we really need now from Bitcoin, in order to feel confident, if I just zoom in on here, the first thing I'm going to say here is that it looks like, tentatively, and I put a question mark on day 57 as the bottom of the 60-day cycle and the start of a new one. So this is where we're at. From the previous cycle here, we bottomed out on this yellow arrow at day 57. So that was last Friday. So we would expect, whenever we start a new cycle, to have some sort of a rally going into the new cycle. It's just what happens with these 60-day cycles. So it does look like that we are at the start of a new 60-day cycle. And the real $60 million question is, how far will it get up to? Does this really have a chance to get back up to the 126,000? And you can decide when I show you exactly what I'm seeing here. And that is, if we have a close look at what's happened here so far in the last 3 or 4 days. So if people are expecting a blow off top above the 126,000 here at the beginning of a new cycle that we've got at this moment, with all the overhead resistance level I've just shown you, and what we've got with this particular candle, which seems to be a bottoming out candle on day 57 on Friday, and you can see with a long wick at the bottom and a little body at the top. So what you've got is a hammer candle, and you normally see these at the bottom of a trend like this one here. So you would expect some sort of a bounce. And if I'm thinking that we're going to get some sort of a blow off top, then I would expect something a little bit more inspiring than what I'm seeing at the moment. So what we've got so far is a small bodied candle here. And to give me inspiration that we're going to make a big move to the upside, I would have expected this candle here, even though it's on a Sunday, I would have expected to give me a bit more confidence that this is going to have a lot of fuel to go to the upside. I just would have expected a bigger, longer green candle here. And I didn't get that yesterday. And so far, as I'm doing this video, we're just getting a red candle here. So there doesn't seem to be much inspiring action. Yes, we'll probably get up to at least this 91, 93, maybe even 95, because we are at the start of the cycle and we've had a really poor rundown. So having gone down there, we have exhausted a lot of the sellers in this region. So what's left is the buyers. And this is telling you a tentative sign that there aren't a lot of enthusiastic buyers here. Even this candle here, I would have expected it to be pushed a little bit further up and given a green candle. So that would have given us a little bit of inspiration. But the following 3 candles are also giving me a bit of a muted feeling that this is not going to be going very much higher. And that one of the levels here is where it's more than likely higher probability it's going to turn around. I really don't see a very strong scenario for this to go all the way up above the 126. But if it does, in the private members section, we're all very well positioned to take advantage of the market doing this. But until that happens, and we do have now a bear market portfolio, which we will be activating once we see the turnaround, once we get this reversal, whatever it's going to be, when we see that turnaround, we will be activating the bear market portfolio to take advantage of the bear market on the way down until Bitcoin gets back down to the $40,000 or the $50,000 mark. And if you're interested in following us in the private member section, this is the record we've got so far in the last 3 years that we've been running the private membership. So we started off back in January 2026 with a portfolio of the Bitcoin miners. We started off with $100,000. We closed that portfolio at the end of 2023 at $434,000, which we took into the 2024-2025. And what we did was to have a look at which portfolio would work the best. Either a passive portfolio where you did nothing at all and just made your choices over here, and that portfolio went to a 10x altogether. We've ended up, so far, we did actually try a counter trend rally which didn't work, so we lost a little bit of money there, but even after that, this portfolio ended up with 1.019 million. So we got a 10x out of that in the current bull market. Starting off with 100,000, we ended up with 1.019 million. And in the trading portfolio, where we did a lot of trades and they were 95% successful, but it just shows that sometimes doing nothing is the best thing to do, that despite the successful trading that we did, that portfolio ended up at 775,000. So it's still a 7x, and it still did better than what Bitcoin is doing at the moment. But there's an incredibly positive learning that we've got out of this. So next time around, in the next bull market, which will probably be at the end of next year, what we're going to do is we're going to have some kind of a passive portfolio with a larger base of companies. And these are the ratio trades that we took part in over that period from January 2024 to just a few months ago when we finished the ratio trading. The blue numbers are in the profits, the red numbers are the losses, and as you can see, 95% of them ended up being in the profit here. So what we're trying to do now is to try and take advantage of a bear market portfolio. So in one of the recent members videos, I gave a bear market portfolio to take advantage of once we see the end of the current rally that we're expecting. Once that turns around, we will be activating a bear market portfolio. And if this is the kind of thing that's of interest to you and you want to join us, we do 2 members videos every week on a Wednesday and a Saturday. And we also do these posts every single day, Monday to Friday, at the end of the close of the play for the markets. This is the last one that we did on Friday. So you can see the type of information you get from these market updates, and whenever there's anything important going on with these charts, I bring that to the attention of the members. And as you can see, we've got the bear market portfolio all ready to be activated as soon as we get the opportunity to do so. So if you want to join us, all you have to do is go to any of my videos, and at the bottom of those videos you'll see the join button here. And if you're on a handheld device, then you'll have to go into the description box where it says the Miners Membership Join link. If you click on that, over the last 3 years the price of a coffee has actually gone up, so the membership has gone cheaper and cheaper. But at the moment anyway, it's at £12.99 per month, and there's no contract. You can cancel at any time. Many people just join for 1 month, have a look, and if they don't like it, they just leave, and that's absolutely fine. But the majority decide to stay because about 80% of the members have been here for the last 3 years, and there's just a few more spaces left. And because people think that we've come to the end of the bull market, few members have left because of that, and that's absolutely fine. It gives spaces for new members to join. So there are a few spaces now for you to join, with so much opportunity going forward, indeed either in a bear market or a potential bull market next year. Okay, so I'm going to leave it there. I hope you found value in the video. If you didn't, please do remember to like and subscribe if you haven't already done so. And if you've got any comments, leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.